and thanks everyone for joining. My name is Jakob, and I'm one of the co-founders at Clearpool, and I'm also the Chief Commercial Officer, so looking at everything related to business development and partnerships. I think most of you are already familiar with Clearpool, but just to recap quickly, we're a decentralized lending protocol for institutions where borrowers that are whitelisted can open lending pools, and those lending pools can then be funded by anyone in the DeFi ecosystem. Today, we have a special guest. We have Sirada here from Alpha Venture DAO. They're based out of Thailand. And we're going to talk about building tools for institutional users in DeFi. And we're also going to talk about a few lessons that we learned from a very turbulent 2022. Just as a heads up, we're also giving out community rewards for answering questions. 2 of those questions will be about Alpha Venture DAO, 2 of them will be about Clearpool, and 1 of them will be a general DeFi question. So always stay tuned for those questions. We'll be announcing whenever we're going to post, and those questions are going to be posted in the general chat. And the first person to type the correct answer is going to win every single time 50 USDC. So you got to be fast in answering those questions. With that being said, I think we can start. So thank you for joining us today, Sirada. We met recently in Thailand. We had a very good chat about what you guys are building at Alpha Venture DAO. But why don't we just start off by you introducing yourself, introducing Alpha Venture DAO, and maybe quickly explain the ecosystem of products you're building.
Sure. Hi, everyone. I'm Sirada, Director of Business Development for DeFi products at Alpha Venture DAO. And we built DeFi products to serve market gaps. And our flagship product is Alpha Homura, which is the world's first multi-chain leverage yield farming protocol and lending protocol with 2 billion TVL back in DeFi summer. We operate on 4 chains, including Ethereum, Avalanche, Optimism, and Phantom, and we build on top of DEXs like Uniswap, Curve, SushiSwap, Trader Joe, and Pangolin. And we serve many institutional users on farming and lending in a permissionless way. If you're new to leverage yield farming, it's a concept that you can borrow external liquidity to increase your yield farming positions without having to own all the capital and gain higher trading rewards than if you farm on DEX directly yourself.
Perfect. Thank you for the quick intro. The way we're going to do this is I'm going to ask you a few questions, and then after every question, I'm also going to give a short comment from the perspective of Clearpool. So let's just dive right into this. So the first question is, what are the main problems in DeFi that you're solving as a protocol? I guess we're talking about Homura mainly.
Yes, so there are 4 key problems that Alpha Homura is solving. So first problem, in traditional yield farming on DEXs with limited capital gives you lower yields. But with leverage yield farming, as I mentioned earlier, that you can borrow external liquidity to increase your yield farming positions, and you can earn higher trading fees and farming rewards from the underlying DEXs without having to own all the capital. And second problem that we're solving is that in traditional yield farming, users require supplying both sides of assets in equal value to open farming positions. But with leverage yield farming on Alpha Homura, you can just supply a single asset, and we offer flexible borrowing of multiple assets in one platform that you can just automate your borrowing and farming in one platform without having to borrow from one platform and then farm on another platform. That's our third problem that we're solving. And finally, on the fourth problem that we're solving is we offer higher capital efficiency through under collateralized borrowing from Iron Bank compared to if you borrow in an over collateralized way from Avio Compound, that would give you lower capital efficiency in overall.
Perfect. Thanks for the overview. So actually, that is very much in line what we're doing at Clearpool. Mainly, we're solving the problem of capital inefficiency with the other larger DeFi lending protocols such as Aave and Compound, as you just mentioned, that they're based on over collateralization. So we're a marketplace where borrowers, as I mentioned, can raise unsecured liquidity, and then lenders they obviously benefit from higher, let's say, risk-adjusted returns. There's a couple of protocols that are operating in this space. We were the first one to introduce dynamic lending pools where lenders can withdraw at any point in time, versus previously the other protocols that have been operating or are operating in this space. They have fixed term loans, where as a lender, you need to lock up your liquidity for several months. The other main innovation that we had with Clearpool are single borrower liquidity pools. So instead of just funding one generic pool and then not really knowing where the liquidity is going, you can choose and pick which borrowers you want to fund, and you can customize your own lending portfolio. So after this first question, there's actually going to be, it's time for the first community question in our general chat. As mentioned previously, it's going to be posted right now, and the first person to answer correctly will win $50 or 50 USDC. Okay, I see the question has been answered. Has been sent. So we're gonna continue with the next question for Sirada. So Sirada would be keen to know more about the history of Alpha Homora. In particular, what types of borrowers and lenders you have on your protocol. I think you mentioned you mainly have institutional participants. So we'd be keen to hear more what type of institutions, what type of participants you have.
Sure. So I'll split into three sections. First is like the history of Alpha Homora first, and then the type of borrower lenders we have currently, and finally the more of the use case specifically for institutional users. So the first section, so back in DeFi summer in 2020, back then when Compound started giving out liquidity mining rewards and starting the liquidity mining trend, we first launched Alpha Homora on Ethereum in 2020, back in DeFi summer period. We also gave out liquidity mining rewards back then and also gained exponential growth during that period, up to 2 billions. However, we learned eventually that it was not the most sustainable growth strategy to grow a DeFi product. Like back then, when the DeFi narrative revolves around yield farming and degen yields, we gain a lot of traction from degen retail users aping in for high yields back then. But once we learned in 2022 that what works in bull market doesn't always work in bear market. So in bear market, like last year, with changing market conditions and lower yields in general, we saw fading retail momentum, but usage and retention among crypto native institutions are still sticky. And that's why last year we gravitated towards our growth strategy towards growing stickier traction from existing institutions to retain existing users in more sustainable way. So some of the specific use cases for institutional users is that many hedge funds and crypto hedge funds and DeFi funds are using Alpha Homora in a permissionless way to do complex yield strategies. And we do reach a product market fit for crypto native institutions that are looking for ways to deploy assets on chain without the need for heavy KYC or regulatory processes. So some of the strategies that are popular on the farming side are market neutral farming strategies, and it's more suitable for advanced users who can actively manage complex yield strategies. For example, if you supply an asset, it's quite like a long exposure on an asset. When you borrow from Alpha Homora, that's like a short exposure, and that nets out the exposure to market neutral yields if you actively manage the position right. And then on the lending side, on Alpha Homora, then institutions can earn interest at lower risk. For example, some popular assets are like ETH lending on ETH mainnet. So that's popular yield strategies for users. And we do serve this needs with the product market fit because crypto native institutions are limited to the amount of funds that they can raise through traditional financing methods for high risk activities like yield farming. So to tackle this issue, we facilitate like alternative financing method that allow users to borrow liquidity and farm in an automated way in one platform conveniently.
Thanks a lot for the detailed explanation. Actually, that's very impressive. So, did I understand it right that at the very beginning during the bull market, you had $2 billion of TVL at some point on the Homura protocol?
Yes, back when we launched on Ethereum.
Wow, that is exactly what's called product market fit. Amazing, congrats on that. Yeah, so I think in terms of institutions, from what I hear, there's definitely an overlap with who is using Clearpool, right? So just quickly, we started off, or we currently have only high frequency trading firms that we're working with in terms of borrowers. So there we worked with many of the leading players such as Jane Street and Wintermute. These trading firms, right, high frequency trading firms, are very suitable borrowers for our dynamic pools since they are actually highly liquid. So, provided obviously that they're solvent, they can repay at any point in time or within a few hours or, max like a day. So that works with our product where borrowers, need to rebalance at all times, and potentially there could be a lot of withdrawals at some point. Also, from a risk profile perspective, they're very interesting as they mainly use these market risk neutral strategies. Our borrowers are mainly operating on centralized exchanges, but they all do have DeFi strategies as well. So I would assume a lot of our borrowers are also users of your protocol. Market risk neutral strategies on CeFi exchanges mainly means that they're doing many small trades, and they benefit from minor price inefficiencies across multiple exchanges. So arbitrage strategies. We are actually looking at launching different borrower profiles with our upcoming Clearpool Prime product. And these borrowers, they would include more traditional trading firms, so non-crypto native trading firms, but also other crypto native players such as Bitcoin miners, such as projects. And we're also looking at fintechs that are providing all sort of lending solutions in the real world. So not in crypto, but they're doing lending such as SME loans in emerging markets or buy now, pay later players, etc. So stay tuned for that. And we're going to have a couple of new borrower profiles, new borrower verticals that we're going to launch in the foreseeable future. Great. So it's time again for the second community questions. Again, there's going to be the question coming in the general chat, and be quick to answer the question in order to win 50 USDC. Oh, I see the question was asked and there's already some answers. So Sirada, we can just hop on to the next question. So the next question, we look a little bit back at this year, and we can hopefully discuss a few, lesson learned and implications from DeFi. So after the CeFi crisis of 2022, so the centralized finance players, large centralized finance players such as Three Arrows Capital, such as FTX, such as Celsius, after they have collapsed, and obviously there was a major market turnover. What do you think about the importance of DeFi, and did anything change?
Sure. So after all the collapse of CeFi like FTX, BlockFi, Celsius, 3AC, in that period between October and November, we saw like a spike in DEX volume from like 65 billions in October to over 100 billion in November. So that's quite a significant signal that people see the benefits of decentralization. And with that going forward, I do think that it builds a bullish narrative for DeFi to gain more market share and brings benefits like transparency, censorship resistance, and immutability, and permissionless on-chain activities instead of centralized platform, and also self-sovereign custody of assets. And another key driver that I think will bring more institutional users to DeFi is that the DeFi yields are generally higher than TradFi yields due to there's no intermediaries that charge agency fees. And for Alpha Homora on our side, we are quite bullish on the DeFi narrative as well, that we can see higher growth going forward this year. We're fortunate that we were not as affected by the FTX crisis, and the activities on Alpha Homora didn't drop as much after the FTX collapse as well, since many of our active institutional users are crypto native and they do mostly on-chain DeFi activities. And we do still see capital inflow into lending and farming in the millions range.
Great. Yeah, I think I completely agree with all of your points. Maybe just specifically looking at the credit market. Obviously, what has happened with those CeFi players just highlights the importance of transparency and highlights the importance of DeFi. Because basically what happened there with Celsius, BlockFi, Genesis, and all the other players was basically that they just offered very high yields, but nobody really knew what they were doing behind closed doors. And then they all started competing for higher yields, and as a result, they engaged in some very risky activity. Losses were hidden and not detected for a very long time until the holes kept growing larger and larger, and at some point it was too late to fix. So basically what happened with those CeFi players this year is nothing new to the world of finance, and it will just always keep happening with centralized entities. And I would say, we at Clearpool, we believe that these failures would have not happened with decentralized and transparent protocols. Now, I want to stress that I'm not saying that you cannot lose money on DeFi protocols. You can obviously lose money on DeFi protocols as well. But at least on DeFi protocols, if done correctly, it is transparent, and the protocol should behave according to strict rules. And those rules need to be hard coded. They need to be visible for everyone, and they cannot be bent by will by any centralized authority or any management that can just change them. And I think this is also a problem for some DeFi protocols, where even though they call themselves decentralized, very often when things get a little bit hectic, sometimes there are changes that are not really in the spirit of true decentralization. So even within DeFi protocols, I think we all need to do a good job, and I think the industry needs to do a better job in order to really be truly decentralized. And then I think things like this can actually be prevented. All right. We have another community question number 3. Once again, it's going to be posted in the general chat. Whoever answers first is going to get the reward. Okay, I see there's already like a lot of activity there, so we can continue. Sirada, maybe we can talk a few about, there's always a lot of talk about institutional adoption for crypto and for DeFi in general, but maybe can you just highlight what are the challenges of real institutional adoption, and what is the current adoption, what players do you see, and what needs to happen in order for it to advance further?
Sure. So specifically on the challenge for leverage yield farming, the first challenge is risk management. Since products like leverage yield farming has risk like impermanent loss, and also users are concerned about like smart contract risk and DPEG risk. So that's like the general risk that people have to actively manage their positions to prevent liquidations and also not affected by the price movement of assets as well. So that's one aspect. And the second aspect is since for DeFi protocols and products like Alpha Homora, we're dealing with users and capital that is quite mercenary and chasing high yields. So the product itself has to offer strong, unique value proposition, just instead of just relying on high yields to maintain sticky usage. And that's one part where we see good product market fit as well, that to maintain stickier usage. And also the third challenge is to maintain deep liquidity at all time. So in order to support institutional users that farm and lend in the millions range, we do need to ensure we have enough liquidity to maintain optimum interest rates for both lenders and borrower, and have enough assets for borrowers and farmers to borrow in the millions range in order to open big farming positions. So those are like the key three challenges that we're always actively managing in order to help users achieve healthy risk-adjusted returns.
Perfect, got it. Just to clarify, I have two questions. Is your the mix of users, is it mainly retail or is it mainly institutional in terms of volumes on your platform? That's the first question. And then the second question, when you talk about institutional users, are you only talking about crypto native institutions, or do you even see interest from more traditional institutions?
Got it. So the first question, the proportion from December stats were about 40% institutional on our platform. About 20 come from lending, and about another 20 comes from farming activities. And when we say institutional usage, it's about like position size or usage that is above 1 million in general. So for example, if you go on Alpha Homora, on like the all positions tab, you can see some yield farming positions in the millions range. So those would be the ticket size of usual institutional users. And for your next question is, so do we see like crypto native or traditional institution? For us, we see more product market fit among crypto native institutions, since the more TradFi institution that will require more regulatory processes such as KYC and AML compliance. So for those one, they are less likely to deploy assets permissionlessly. And I think that would be more of the segment that Clearpool is serving.
Yeah, thanks a lot for clarifying. I think for us it is similar. We do have for our permissionless product. I think it's a great product market fit for a lot of crypto native institutions, but we do also see some of the traditional institutions that are already participating. I think you said something which is very accurate. In order for the more traditional institutions to come into DeFi, there is something that prevents them to do this, which is pure DeFi, and yeah, that is a clear regulatory framework, and that is some compliance around KYC and AML. This is actually why we are launching Clearpool Prime. So Clearpool Prime is a more institutional platform that is catered to those more traditional users. And on Clearpool Prime, we have both lenders and borrowers fully KYC'd, and we'll also conduct AML checks. And maybe something that you also touched on, also when it comes to assessing risks, we see that, sometimes for slightly more traditional players, it can get quickly quite overwhelming to do assessments on protocol risk, assessments on potentially even stablecoin risk, counterparty risks, etc. So we definitely see that there are some concerns and it takes them a little bit longer. We see that there's a couple of players who are tackling these markets, and I think there's a lot of opportunity there as well. But that being said, we do see at Clearpool that many large financial institutions, and we're talking with the largest financial institutions in the world, they're either already started to enter the blockchain industry. A few of them are already active on DeFi, and the other ones are at least considering or planning their DeFi strategies. So I would say that in the year to come, we will probably see a lot of movement there, and we're very excited with our upcoming launch of Clearpool Prime. All right, it's again time for a community question that's going to be posted in the general chat. Okay, this has been posted. We can move on to the next question. So again, looking back at 2022, I think you already touched on it a little bit. You mentioned that you had a very, very big volume on Homura, and then it's a lot of the like crypto native, I would say, like degens that were after just high yields, they dropped. But I just wanted to understand a little bit better. Can you go into a bit more details on how Homura has performed during the market turbulences in April and October this year, and what were the lessons learned?
Sure. So I'll go quarter by quarter, and then I'll close out with the key takeaways that we learned. So back in quarter one, our TVL was in the billions range, and our traction on Avalanche was like the strongest, and we had traction around like 600 to 700 millions back then. We were giving out like extra liquidity mining programs from Avalanche Rush program, and then also in Alpha tokens as well, which were quite effective in helping to bootstrap liquidity back then. And we were going to scale to Terra as well, and we almost launched, but we were quite fortunate that the Terra ecosystem collapsed first before we launched. So we quickly adapted and shifted our direction to launch on Phantom instead and gain a bit more TVL back then. So back in quarter one, things were still fine. And then when we entered quarter two, that's where the TVL significantly dropped. And those were due to several factors. So one, Avalanche rewards ran out, which was quite expected. And on Phantom, there were fading momentum on Phantom due to news about Andre as well. And then there were also crypto funds affected by Terra crisis. So that all adds up, and we saw like significant TVL drop back then. However, what we learned is that we learned to be quite agile, and we shifted our strategy quite fast to be less reliant on liquidity mining rewards, because we did anticipate it that after the rewards ran out, we do have to shift our strategy towards a more sustainable growth strategy, and we focused more on driving stickier usage from active institutional users. And also we grew Alpha more integration hub to increase use case of the protocol, and we grew a pipeline of partners that built yield strategies on top of Alpha Homura. So in quarter three, there's more CeFi collabs happening, and again, that was where we were focusing more on the strategy to build good product with strong value proposition to maintain the TVL and survive that period. So we were the first to launch the first liquidity providing on Uniswap V3 on Optimism back then. And that roadmap, it helped us gain really good organic traction with also first mover advantage and strong value proposition without the need to rely on giving out liquidity mining rewards, and also to withstand the turbulent markets. And finally, in quarter four, so that's when the FTX crisis happened. So unfortunately, we were not affected by the FTX crisis since we didn't have treasury exposure on FTX, and also mostly most our users are crypto native and they deploy assets on chain. So we still see high capital inflow in the millions range, and we also build stronger relationships with existing institutional users who love our products and has been using our products since launch to help maintain the traction. So some key takeaways from all that. So one, how we survive a turbulent market is that we focus on building good product that users love and delivering strong, unique value proposition to drive organic traction without relying on liquidity mining rewards. And two, so we maintain high adaptability and speed to adjust to any situation. And I think that's the key to driving traction within a startup environment, is just to be really lean and agile. And third, so we adopted like user-centric growth strategy to maintain sticky attraction and retention rate with existing users that we see quite active, and we're actively building relationships with them to help improve retention rate.
Okay, thanks. Thanks for the detailed explanation. Once again, I think something that we've heard, a few times already from you, and I think I can only agree, is that this year clearly showed us that liquidity mining is not the solution. It's something that only works in a very in a bull market, basically in a bit of a bubble. And in order to really make a difference in the longer term, you actually need to have a good product that users want to use. And I always said the best way to look at any DeFi protocol is to just completely take the token out of the equation and just look at the product. And if that product is by itself already good, then it's a good product, and otherwise it is something that sooner or later is probably not going to survive. So I absolutely agree here with you. I think just on our side, we launched end of March 2022. So we had a very short period where everything was calm, and then very, very soon after we had the Luna 3AC Celsius incidents, one after the other. That obviously had a negative impact in our TVL. So our TVL dropped very significantly after those incidents. However, again, what we saw, we had a very, very strong growth throughout the year. I would say up until October when FTX happened, we had very, very strong month-on-month growth. And the main reason is that when we build our product, we focused on making a very, very good product, a very good value proposition for our lenders, right? And that value proposition, the main one was that we were the only unsecured lending protocol where lenders had the possibility to withdraw their funds at any point in time. So, we realized that before this year, before anything happened, there were no defaults. Lenders might have not, they didn't mind locking themselves up for several months because everything was okay. But, as soon as problems arise, liquidity was valued a lot more. And by being the most liquid platform, we actually managed to grow significantly, while I would say the rest of our sector, but I would say the rest of DeFi in general, has been decreasing and declining steadily. This was up obviously until November, when FTX Alameda collapse happened. That was a very, very large stress test for our protocol. Obviously, the lenders were afraid. They were very risk off, and everyone withdrew their funds from the protocol. I think here, we actually see this as a positive and not as a negative, in the sense that there was a very, very strong stress test for a protocol, but the protocol worked as intended, and it actually allowed lenders to de-risk over 150 million. So I think at that point we had 165 million USD in total liquidity provided, and very, very quickly that went down to 15 million. So 150 million in liquidity were de-risked or were withdrawn within a matter of days. and the protocol managed to do that without any issues. And that has given a lot of confidence to lenders as well, that obviously many of them are still on the sidelines. They are still waiting of what's going to happen for the market to rebound. But we are confident that once the market rebounds, and we believe it will definitely bounce back, there's also going to be, again, appetite to borrow. There's going to be opportunity for these trading firms, and there's also going to be appetite to lend, obviously to the right players. Of course, here, the lessons, again, transparency is key. There's really no one too big to fail, and there is no excuse for anyone not to be or not to be held accountable to the highest standards in terms of risk assessment and transparency. All right, then, Sirada, I would like to know, what is your outlook for DeFi this year, 2023? How can DeFi further provide value, and how can DeFi grow further?
Sure. So I'll split into two sections. One is like DeFi in general, and then another one, key drivers for like institutional DeFi specifically. So in DeFi narrative in general, there's some big narratives happening that I think could be some key driver for DeFi lending this year. One is like real yields, where the narrative is shifting towards like really high degen yields, towards real yields from good products, and users care more about risk management and risk-adjusted returns. And two, we do see growing in usage in like L2s, and also the narrative of Ethereum growing quite massively this year. So we do anticipate higher traction among Ethereum ecosystem and also L2s in DeFi lending. And also the third narratives that's quite big this year is liquid staking derivatives, or LSDs, which it can help really accelerate the adoption of like ETH staking in a more liquid way, which can also drive a lot of DeFi activities, and potentially these assets could turn into like collateral assets that could help drive DeFi activities like lending going forward as well. And the next section is specifically for institutional DeFi. I think key driving factors. The first one is security. So once what happened to like the CeFi players, users would care more about where they place their money, where they park money, especially if it's for institutions in a millions range. So for example, Alpha Homora, we have rigid security measures, from rigid token listing framework to supporting blue chip assets only, and also audited by top firms. We have active bug bounty program in place by ImmuneFi. We have insurance options by insurers and Nexus Mutual. We whitelist contracts, and definitely non-anonymous team to help gain more confidence from the community as well. And we also have restricted use of borrowed fund to only leverage yield farming to reduce default risk. And also the next factor that would drive institutional adoption in DeFi is transparent real yields, right? So not just real, but you need transparent. And we show that through like transparent calculations to make sure users get what they deserve to earn. And also, finally, institutional support. So with that more growing trends in institutional adoption, also DeFi lending, we anticipate that these activities would grow. So we have like BD and product teams help facilitate new listings of assets, new farming pools, for new yield strategies that matches institutional requirements, and also instant support on technical issues where these institutional users are comfortable to park their money in a millions range with us, and they can contact us whenever they need us.
Great, thanks, Sirada. I think you covered a lot of points that I was thinking about as well. I think just maybe to add here from a Clearpool perspective, we believe that more regulation is going to come, and we believe that in order to really drive institutional adoption, we need to have a solution that is compliant and they can work with. And once again, this is why we have developed Clearpool Prime, and we do think that institutional permission DeFi is going to be a trend this year and in the years to come. Maybe in terms of lending, another category that we are very actively looking at and following, and we are currently onboarding a few real world asset lenders. I already mentioned that previously. So it's fintechs that do not operate in the crypto space, but they are providing lending solutions to SMEs or individuals in emerging markets or also developed markets. And that asset class we see is also currently very, very hot whenever you talk about about DeFi lending. And this is obviously also has to do with the fact that there were a lot of crypto crashes. There's a lot of risk and uncertainty in the market. So having non-crypto related exposure, but still benefiting from the increased transparency, efficiency gains, and composability of DeFi can be a major value proposition. So we also believe that real world asset lending is going to find wider adoption this year and in the coming years to come. Finally, as I mentioned before, I think I hope FTX and Celsius, etc., will be a lesson for everyone. So when it comes to anyone participating on any DeFi protocol, especially for unsecured lending, we think that the borrowers would need to provide a lot more transparency. There's going to be more focus on real-time data. There's going to be more focus on having audited financials. And it is just important that we do not, or as an industry, nobody assumes that certain players are basically playing in a different league and do not have to be held accountable for what they do and do not have to provide transparent information. All right, it's time for our last community question that's going to be posted again in the general chat. Let's go. Okay, question is posted. So final question for Sirada and Alpha Venture DAO. Could you maybe just comment on the future roadmap for both Alpha Venture DAO and Alpha Homora?
Sure. So for Alpha Homora, we're quite bullish for DeFi products and for the usage that we see going forward this year. We still see sticky usage of Alpha Homora even after the market turbulence, and especially on ETH mainnets and L2s on Optimism. And we're doubling down our efforts into developing the platform, and we're anticipating more institutional capital to flow into the DeFi space. And for Alpha Venture DAO as a whole, and also Alpha Homora, we're cooking new derivatives. So we will be having some big product updates coming out soon towards end of Q1 and big narratives coming out soon. So stay tuned and subscribe to our social media channel, and we'll leak more info publicly shortly.
Awesome, thanks. Yeah, just on the Clearpool side, the next big launch is obviously our Clearpool Prime product, where we're currently in the very final stages of getting ready, and we already have we already have the first borrowers that are being onboarded. I think I already mentioned it several times, but Clearpool Prime is a more institutional focused platform. Everyone KYC, both lenders and borrowers, and it's also going to be a little bit different to our current permissionless product in the sense that we're going to have fixed term loans, and borrowers basically can come in, they can request, or they can send out a loan proposal, and these loan proposals can then be filled by whitelisted institutions within that Clearpool Prime network. We are also looking at several new products for our permissionless product, where we really see what we've done, until now, just as the first, primitive, which we are very excited about that it has found product market fit, but now we are looking to build more product and add more value on top of what we have right now. So there's exciting products coming up. I'm personally very excited about our ETF product. So it's a product where, as a lender, you can basically buy an ETF that will allow you to get diversified exposure across different borrower types. And then, once we have different borrower verticals, you could have one for high frequency trading firms and one for fintechs and whatnot. We also have a product that we also have the fixed term pool product that is on our roadmap, and the fixed term pool product is then also going to allow us to do secondary trading of LP tokens, and there's a couple of other products that are following as well. I can't tell too much, but basically we're really planning to build this a full decentralized capital market ecosystem, and what we have so far is just the first building block of what's about to come. I already mentioned that we are currently onboarding different new borrower profiles. So we're going to launch new borrower verticals, and we're also going to launch different currencies. So far, Clearpool, we have only focused on stable coins. Actually, we only had USDC pools. We are also getting ready and preparing to launch different currencies such as Ethereum and Bitcoin. Great. So I think we are at the end of this AMA, Sirada. Thank you so much for joining us. Thank you so much for telling us more about Homora, about Alpha Venture DAO. It's been a great pleasure, and I think it was very, very informative for me, myself, and I think for our whole community as well.
Thank you, Jakob, and thank you, Clearpool, for hosting the AMA. And it's great to learn more about Clearpool and institutional DeFi, and also get to know more about Clearpool community as well.
Great. Thanks a lot.